All right, everyone. Welcome back to a markets conversation with Sam Rule, senior analyst over at Bitcoin Magazine Pro, formerly known as The Deep Dive. This is being simul-streamed between Bitcoin Magazine Live on YouTube, Rumble, and everywhere else where you can get video, as well as on Twitter Spaces here on Bitcoin Magazine Twitter. We will also be posting the recording as a podcast over at Bitcoin Spaces Live and on YouTube. So a lot of places to get this conversation. It's going to be wide ranging. We're going to be talking about the stuff that Sam and Dylan LeClaire have been writing about in Bitcoin Magazine Live. Sam, really excited to have you here. We're also joined by McShane, Q, Chris Alemo, our producer. And I guess let's kind of jump into what is Bitcoin Magazine Pro? What is the product that you're working on, Sam? Why don't you tell everyone about it?
Yeah, totally. Can you hear me okay?
Yes, sir.
All right, cool. Yeah, what's up, everyone? I'm Sam. As CK mentioned, I work with Bitcoin Magazine. I also work with UTXO Management, which is a Bitcoin fund. Pretty much an analyst on both those companies. The main thing that I focus on led with Dylan LeClaire, who's out enjoying Europe today, as you can see by his Twitter. We put out a research and analysis product on everything Bitcoin market dynamics. So we go over macroeconomic conditions, Bitcoin mining, derivatives, on-chain analytics, anything that's interesting about the Bitcoin market that can be told through data, charts, information. And we try to piece those things together, figure out what's going on, give that to readers in an interesting format on both kind of free and premium subscriptions. So if you're ever interested, you can check out the Substack link in my bio. Free subs, we send about an issue once a week, and premium, we try to put something together every weekday when we have something good enough to cover the market. So a wide range is kind of what we shoot for, and really just try to understand. We're learning and educating ourselves as much as we do with other people. So yeah, I'd say that's what Bitcoin Magazine Pro is about.
Awesome. Yeah, and I guess Sam, maybe your audio is coming in a little choppy, so maybe you can QA that a little bit. Q, I guess, do you want to jump in? I know I've been reading the last few newsletters, the one that you dropped on Monday about just the bigger overview on the Bitcoin market. I know there's a lot to dive into there. I know you've been dropping a lot of content, Sam, on your Twitter this week. So I guess, Q, why don't you kind of get us kicked off with the first question?
Yeah, Sam, why don't you paint us a little bit of a picture of the Bitcoin mining landscape and Bitcoin in general? You guys wrote an excellent piece at the end of last year, kind of highlighting what the Bitcoin miners in the public markets were able to return versus Bitcoin miners, and then what you have now seen from the start of this year to now.
Yeah, totally. Is the audio sound any better there? Clean? All right, cool. Yeah, so typically what we talked about a lot of these previous spaces is going over kind of some of the macro cases, especially over the last few months with Bitcoin, talking about VIX, equity correlations, bond markets, things like that, kind of how Bitcoin fits in that bigger macroeconomic picture, because it's been really important. But, another piece that we like to cover that's just as interesting, maybe not as interesting on the price at times, is like the state of Bitcoin mining. So really wanted to last week, free for anyone who wants to go check that out. It's really a holistic view of what's happening in the Bitcoin mining space across kind of public Bitcoin miner data, especially. That's some of kind of the best data that we can get on where Bitcoin mining is today and kind of where it's going in the future and where it's gone through. So that issue is highlighting a lot of that. And, kind of the key piece and some of the first couple of charts there, looking at like the year-to-date performance and like performance from all-time highs for these public equities across, public mining stocks like Marathon and Core Scientific and Riot, and just looking at like really the performance related to these miners versus Bitcoin. And hilarious enough, like if you looked at this chart, Bitcoin versus miners or Bitcoin versus equity stocks, you'd probably get something similar with maybe a lot more downside in Bitcoin miners. Bitfarms CMO had a great quote, essentially like when Bitcoin goes up, miners should go up more, and when Bitcoin goes down, miners should go down more. So kind of looking at like the kind of the sophistication strategies around that performance, why Bitcoin miners are interested, and we can get into some of the details too, based on questions, or I can just keep kind of rolling through what we put out. But I think it's an important question, an interesting one for like people who are getting into Bitcoin, looking for Bitcoin exposure across all different vehicles, spot ETFs, futures, Bitcoin miners itself. I mean, self-custody options are probably the best bet and the thing to do for most people. But then you have like some of these other sophistication strategies and attractive opportunities for investors. So kind of wanted to dig into some of those performance and kind of analysis there in that piece. And then, go over some of the data they were reporting and also what that looks like for hash rate and hash price and some different metrics in money.
Yeah, I mean, I think one of the really interesting things about this latest report that you guys put out, and just a lot of the conversations that we've been having on this show, the idea that like right now, there's no way to have direct access to Bitcoin investing or exposure to Bitcoin through a 401k or any sort of retirement account, with the exception of now you have some public miners, you have certain ETFs, spot ETFs, you have MicroStrategy and whatnot, but it's a very limited pool versus the entire pool of just the broader stock market, the broader investment vehicles that are available to people. I think one of the things that you guys highlight very well in this piece is just the idea that while these risks on assets are, I think I said that right, that they're still able to sort of have higher betas and higher volatility as a result. You had better returns last year, but you're also seeing now a little bit of a drawdown this year. I'd love for you to touch on a little bit of just what you're paying attention to, whether it's supply chain issues, whether it's just overall growth and hash rate of the ecosystem at large. What are the factors really playing into the growth of Bitcoin miners from last year and into this year now, or the decline into this year now?
Yeah, totally. So you made a good point in terms of like differentiating the two. These are different investments for different risk appetites. There's a lot more sophistication if you're thinking about getting into a Bitcoin miner. Just basically you have Bitcoin. You're looking at the upside of the adoption curve and where it's growing, and kind of the network effect that's going to play out. And then if you're looking at it like investing in Bitcoin miners, it's everything from capex and opex and the general cost of mining, which is lower for them, but also expansion plans and kind of market cap valuation. So it's a lot more tricky there. But basically since like November, you have this whole turnover in risk on assets. Bitcoin included miners, those charts, you can see that some of these miners are down 60, 70, 80%. And in Bitcoin terms, just starting to go down like really over the last 6 months as well. And some of these had kind of like a great return in Bitcoin terms if you're looking at it over like the last year and a half from like the mining industry standpoint. So if you look at like someone like Marathon and Riot, they're returning like 70% and 200% in Bitcoin terms over the last 2 years. And a large part of that, like overall in the mining space, it's been a bit of a golden period in Bitcoin mining and in a gold rush right now. And all of these miners are looking to try to expand their operations as much as possible. And kind of a big reason for that, through 2020 and into 2021, 2020, you had some kind of events play out when mining was really large in China. You had flooding, like kind of mass flooding effects that took hash rate offline. You had kind of Bitmain supply chain issues with ASICs that were coming out. And what a lot of this does is, it takes hash rate off the network. But for miners who have hash rate on, they're going to be making more revenue per hash that they're putting out. So it's a more profitable time. It's more revenue coming in. And it also came at a time where we kind of have like a retail bull market playing off too. So it took this metric, which we can cover in one of these charts, hash price. It took this into like what is a usually deflating metric over time as mining becomes more competitive. And it was hugely profitable for valuations, for earnings, for anything like related to growth for miners. And I think, they're taking that opportunity, especially post-China ban, to kind of ramp up their output and like scale up as much as they can. And so, one of those issues today is that a lot of machines were bought and a lot of machines are still being bought or getting deployed and scheduled. But now it's kind of post this China mining ban when hash rate went down to like 84 exahash. you need a place for all those machines. So there's power capacity issues, there's infrastructure capacity issues. Guys at Luxor just put out some great details on this, and essentially, it constrains the market. And you want to get all this hash online, and we can talk about some hash rate projections for what this year might look like. But that's kind of the state of everything today, is like those miners are scaling up as much as they can compared to last year. It's kind of an arms race to get hash rate online. They make up about, something like 10 to 13% of hash rate, depending on how many public miners you're accounting for. And they're expected to take up like over 30% of hash rate by the end of the year, based on their projection plans. So that's kind of a little overview. Happy to, we can dive into some more of those specifics.
I think before we do that, for maybe some people who aren't as familiar with what exactly is hash price, can you explain where that number comes from?
Yeah, totally. So it's really just a metric for miners to track how much revenue they're getting in terms of like their machines and output that they're putting on the network. So that is like market value, which is a total revenue that miners can make over like per unit of hash and power, hash just being kind of the computational output that these ASICs are putting out to solve kind of these block rewards and transaction fees kind of computation. So it's measured as dollars per terahash per second per day. And so the more hashing power that comes online and revenue kind of stays constant, the less revenue, like hash price or like revenue per miner per unit of hash is going to be for the network. And so like reverse, if miners all of a sudden getting more revenue as Bitcoin price rips up, the hash rate holds the same on the network, they're getting more revenue per unit of hash. So it's really kind of this calculation measure. There's, you can also calculate like cost per hash as well, kind of terahash. And so then you can get this idea of like how profitable it is to mine at a certain time. So it's a really good indicator of like how generally what the network is in terms of how much revenue they're making, all costs held like equal. Hash price going up, it's more profitable time, going down, less so.
That makes a lot of sense. And I think that the explanation of hash price is really, really important. This is going to be a pivotal metric for us to continue to monitor as hash rate in this ecosystem continue to develop. I just want to give a shout out. There's like close to 200 people over in Spaces. If you want to see these charts, we're sharing charts. We're going over this research in detail on video with Sam over in YouTube. So if you go to the first pin or the second pinned tweet, you can go straight to there. So check that out. It's a great resource. But yeah, I mean, Sam, just kind of sticking on the miner just ecosystem. A huge dynamic has been miners hoarding Bitcoin, miners not selling, miners being able to finance using the public markets. Just kind of going through what I'm seeing in the ecosystem, things are getting tighter, prices not moving as quickly, and expectations are changing. But with that being said, I don't think that many of these organizations are looking to sell Bitcoin as their first option. I feel like that's almost like their last option. So I guess, can you talk about these dynamics in terms of, will these public miners hold Bitcoin or continue holding Bitcoin the way they are? And if that changes, like what do we have to kind of like think about these dynamics here?
Yeah, totally. The way I think about it is like overall, these public miners now have a huge access to financial markets across debt and equity, have been leveraging that. You can see some of those deals and getting revolving lines of credit with someone like Marathon at Silvergate. There's been a couple other miners to do some similar deals. They're taking on a relatively higher interest rate, but getting a revolving line of credit where they can deposit USD or the Bitcoin they're holding. So that helps Bitcoin as collateral if they want to keep that on their balance sheet. And there's thresholds they need to operate for the valuation of that collateral as well. But essentially, miners are, I think, comfortably getting to a scaling point where they are trying to take on as much Bitcoin on their balance sheet as they can, and pretty much committed to the markets across most consistently in their investor relations and monthly production updates that they're committed to doing this. And so, just tracking some of that information, like and I think is a useful way to say, okay, are they reverting on some of the things they're talking about and holding Bitcoin on balance sheets? Is that changing? That could signal time potentially that they need more cash flow. It's kind of a treasury that they can access when they need to. They don't have to stack, but they've kind of committed to their investors that they're doing so. Just over last month, those holdings were up 7% month over month, and they've been increasing pretty much over the last year. So you have a little bit of this macro shift where, whether it's the scale, whether it's the access to financing, debt, equity that they have available, whether it's that they expect to be growing their market share and they kind of have the viability to be able to do this, it seems like a trend that's here to stay. So just in terms of data, that's monthly data you can get, and you can see that like kind of reverse course if we're gonna like get into maybe more of a capitulation event that we're in right now. But I think at the other side of that too, like the hash price is still in a pretty appealing spot. It's around like 17 cents, and it's come up from a very long trending low of like 7 cents. So Bitcoin mining is still in a very strong revenue profit driving period as well. And so I don't think we're too much of a risk of seeing some of these miners revert. But if you're going to, it's definitely going to be seen in like the Bitcoin holdings data that they're coming out with. Even interesting, I think Hive related had a note last time in their piece that they do some Ethereum mining too, but essentially they're selling their Ethereum for Bitcoin as well. So when you have miners that are doing both, in some cases, you can see those dynamics when they're trading one asset for the other. So it still seems relatively pretty strong. I think it's more of a macro trend that's here to stay over the next 3 or 4 years. That doesn't mean you might have some capitulation out of some miners or potential mergers and acquisitions if one miner has, maybe bad operational executional risk on that front too. But it's something, it's been pretty promising. We've seen on like the on-chain analytics side, there's some measurements to see miners sending Bitcoin to exchanges, and essentially that is just like a down into the right trend over the last like year, 2 years when you're looking at kind of a 90-day cumulative. So you're seeing a lot less activity and kind of sell pressure from larger miners overall that are ultimately going to be having, closer to 30% of the network by the end of the year if the kind of their expansion plans play out.
Before we dive into actually the expansion plan and how it looks like pacing wise, I do want to ask you, and maybe this is more of I may be assigning you a new project to work on, and if so, I'm sorry. Is there a price level for either the Bitcoin price itself or for just the general hash price to hit that might trigger some of these miners to have to capitulate and have to sell something in their reserves to keep growing at the rates that they're promising?
No, totally. There's a great metric for this that was created by David Puel in the Puel multiple, which is really tries to gauge selling pressure potential on the market. And so I don't have the exact kind of numbers in front of me of what that might look like, but essentially what that looks like is the daily kind of miner revenue or issuance that they're getting over the last 365 days, kind of an average. So it tells you, hey, based on the last 365 days, here's what miners are making in terms of revenue, here's what they're expecting for plans. And like when we get a price crash, in terms of like what level is that below in terms of kind of a rougher standard deviation. So there is a multiple and a ratio there that has kind of articulated pretty well in the network at large. Essentially, I think you're going to have hash price probably trend towards like 10 cents through the rest of the year. That could affect maybe smaller, more unprofitable miners to have some capitulation, turn machines off, look for lower energy sources. I don't necessarily think that's a lot of pressure on larger miners in terms of like that cost profile. I don't know if I have an exact number in mind. I imagine once you start getting down into like below 30 into like 20,000 type levels, and then you're seeing this hash rate expansion at the same time, which makes it harder to drive revenue for a national network for miners. That could probably potentially see some issues because right now you've got an interesting dynamic where you have hash exploding and expanding, and it's up 27% on the year today. I think previously in this report right out of 22, which is maybe a little bit lower growth than what people are expecting for the year. But then you have price down of 18%, so you're seeing this pretty big divergence. So not a number in mind, but probably a good project or scenario to map out what those look like.
Can you touch a little bit on, like, there were some very lofty expectations set by public miners to reach a total of over 300 hash rate. I believe, if I'm remembering that number correctly, or those figures correctly, we're about a third of the way through the year now. How is it looking as far as hash rate expansion going? Are they pacing, keeping up with pace? And what are your expectations given some supply chain woes and everything that's been going on for the rest of this year?
Yeah, totally. It's a interesting way to think about it. I mean, at the end of the last year, you had a really good Galaxy Digital report out that put out 300 exahash kind of number for the year. Some other kind of mining reports, people thought of something similar, and so that's kind of been like this ballpark number to think in the head of. Maybe it's an expectation, maybe it's just kind of a target to see will hash price hit that, especially kind of after this kind of China post mining ban. But what's interesting is, like, in terms of all the larger public miners, you're all going to find that, like, they're expanding like crazy. And there's a good chart in here just to show of those reported figures. And this is not all the public miners, kind of their current hash rate of what they're expecting today and where they're going tomorrow. So by the end of 2022, and even some of these estimates are kind of like early 2023, depending on if there's not any delays here. So, but what you see is that you've got like a basically 37 exahash online from this group, and there's probably a good 4 or 5 sizable ones that are not in here, depending on kind of they're not having 2022 estimates like completely clear out there, and they're expecting to go over 90 exahash, and so it's 154% growth from this group. Now that said, like, deployments have been a little bit slower than like anticipated from these miners. So a lot of that is, kind of what we were talking about before, is you have all these machines, you have them ordered. It was kind of a fire sale, like when these mining rigs went to like super low prices post China mining ban, and then you're able to get them on discounts and lower prices, and you have this kind of collapse in price as well. But the hard part is, power generation, infrastructure capacity, kind of labor shortage as well to get all of these things plugged in. And so that's really the issue now, and kind of the trickier part. And some it's curbed some delays. So like Marathon recently came out and said, hey, we've got kind of a 45 delay on this megawatt plant that we're trying to get up, kind of the connection grid set up. And so it's curbed it a little bit. But I mean, if you look at another way to look at it is to just look at like where the hash rate growth is today. So after 4 months or close to, we're somewhere in between 22 to 27% over these 4 months. And you start to annualize that out, and you get a pretty decent sized growth rate if this is going to continue and to the expansion plans that we talk about. And then you're looking somewhere about like a 280 to 300 exahash by kind of the end of the year. And what's interesting about that too is just like hash rate has been on this trend where, like, you look at it over the last 4 years or so, you have like an 80% growth rate. 4 years ago, then another 80% growth rate, a little bit less than that, and then you have the network that still grew 22% even post China mining ban, and all of that happened. And now you're getting a little bit even more of a rebound year, kind of back to trend. So you have like these 80% growth rates happening in really hard fall to 22%, and now kind of coming back to that. So it's not as a sophisticated way to say, hey, here's all the rigs and here's all the assumptions of when these are going to come online. So certainly delays. I would still say that something like 280 exahash is still in play for the year, based on a lot of these, like you look at Core Scientific or Northern Data, who are not only doing their own self-mining hash rate, but they're doing like managed services as well, and having the data center in the rack space as a business. And they're incredibly, like, Core Scientific, is talking about taking 13 exahash today to over 42 by the end of the year. So I think you take it with a grain of salt that all of these larger miners want to bring that hash on, they want to scale it out, all these plans, but there are some delays in some of these that will affect it for sure.
Can you touch on maybe like 2 or 3 of those delays, whether just based on what you're seeing out there in the market? Yeah,
no, I mean, I would just say like a high level view is just like getting the machines plugged in. in terms of like infrastructure, right? So like you need the rack space, you need the energy generation sites, you need the megawatts capacity, and all of those are just essentially getting built out by all of these miners today, a lot of different locations, especially around North America. So most of those delays are just how long it's going to take for those sites to come online, and then you're going to be able to plug in those machines pretty much.
Sam, I'm kind of curious. A lot of people have been making more money on public miners than Bitcoin. Obviously, we've been talking about how we are reverting back to these stocks underperforming Bitcoin. How do you think that retail investors should try to like navigate stocks, Bitcoin? You know, obviously nothing can replace hodling your own coins, but given like, you know, potentially a bear market, that's something we haven't really talked about quite yet, but, you know, given changing tides, you know, where do you think there's like the least market risk in terms of allocating capital beyond just holding Bitcoin?
Yeah, I wouldn't, I mean, I can kind of paint what like my thoughts in terms of if you were someone who wanted to hold Bitcoin and you want exposure potentially to miners as well. So if you think about it in terms of like Bitcoin terms, like Bitcoin's your unit of accounts, I think one thing that's pretty interesting from these miners right now is that they're all hitting these near lows in Bitcoin terms. They look similar to kind of USD charts, but all below average over the last year, all incredibly tanking. And so you're looking for these opportunities. And I think, you know, Preston Fish makes a really good point about this. It's like, at what point, if you're ever going to sell your Bitcoin, and this is probably more way into the future, it's the time when like Bitcoin's your unit of account, you want to take some of that and you think there's upside to grow that beyond like Bitcoin's growth rate today. And so that's when like some of these miners look terrible in Bitcoin terms. And that's like really key. And so right now they're going through that, obviously 70, 80% down for some of them. You know, there's different risk profiles in that. You know, you look at some of these, it's incredible outperformance in more bullish markets and hash price times. In bearish, you probably want to see more of a capitulation potentially play out, or like a further low in equities before, you know, saying allocation to that. But ultimately, if like you're getting these things on the cheap in Bitcoin terms, then that can be a good time to take, you know, some of what you think. If you're interested in that, it's more of an investor allocator, like capital decision. If you want to go through like the valuations and check that out. So yeah, I don't know if that is a decent answer to your question, but it's more, I don't necessarily recommend saying like, hey, you know, take some of your self-custody stack and do this, because I think you need to be cautious of like when your valuation metrics, when you're looking at these, and, you know, we're going to be publishing some more of these on miners in the future. But ultimately you're giving up this self-custody option. It's typically kind of a more sophisticated option for miners that are more attractive to like higher institutional capital, or when you have like regulatory risk or retirement accounts when you can't access these things. But at the end of the day, a lot of miners are, you know, it's 0.8, 0.9 correlation for the most of the time, depending on the miner to Bitcoin. So it's pretty close. I would say it's, I'd be more cautious to take on minor allocations unless like you see like incredibly cheap valuations in a bear market. Typically, you're going to get more upside in a bull market for miners, especially like during periods of higher hash price.
I'm curious, and like I'm more just curious if you maybe know this from the time you've spent looking at stuff like the historical hash rate. But has the halvening had any effect overall as we sit 2 years away from the next halvening, or is it just more focused on as wallet sizes or the number of wallets grow, as the number of total Bitcoin users grow, so too does hash rate?
Yeah, totally. I mean, the halving definitely has relative effect on like in terms of the block rewards that you're going to be getting, right? So like if all else equal, right, price stays the same, you're getting lower block rewards per that. You know, ultimately it's competing for a scarcer supply of like Bitcoin for those subsidy rewards and those issuance. And so more hash rate coming online to just compete for that kind of lower amount. But I think hash rate is just also in this like natural arms race and expanding for kind of price all the time. It's still incredibly profitable to be a miner if you have the scale. I mean, maybe less so. It's becoming tougher as home miners and getting more innovative and efficiencies and thinking about where you can get like lower energy sources of power and cost. So I think it does have an effect because everything that, the rewards are all becoming scarcer. It's getting way more competitive over time and it's so lucrative. So as long as, you have a low kind of marginal cost of production and that's driving lower and you're getting more efficient ASICs as well, then there's still a good, profit and revenue to be made overall in mining.
Sam, I want to transition into talking about bull bear markets. I have insider information saying like, hey, excitement at exchanges is not the same as it used to be. I think a lot of people feel the angst on social media, and the Bitcoin super cycle, the end of 4-year cycles, these kind of like narratives that were playing out in late 2021. It seems like they've quieted down a lot. I want to hear your take.
Yeah, totally, for sure. So I think to talk on that, probably it's good to talk through like thinking that, I was going through in the fall. Basically, you're having price shooting up to new highs. You're looking at, okay, everyone's speculating on what level of kind of like institutional demand is coming in. Like the supply side from what we look and study from like on-chain metrics and kind of just everything else in general in terms of data we're looking at was so incredibly bullish relative to other periods that we've had before. But obviously supply side is like totally one side of the equation. And kind of, really into November, you have this total shift of the market where I think you had a little bit of a runway before you had this broader macro market regime that was playing out regardless of what Bitcoin's market was about. I mean, Bitcoin is so small still in compared to the rest of the assets. So when you get like this broader macro market regime shift, it's tough to sustain what was happening. And it doesn't help that also, kind of the China kind of mining ban there kind of deflated some of what could have been kind of higher price cycles as well through what we had. So all that said, I think, you start seeing this lack of demand, you start to see this like more macro regime changing kind of in November, through December, we started really focusing on a lot of that macro market regime shift and what it means for Bitcoin. So I think that's maybe a cost of like what the institutional adoption is a little bit. It changed away from these traditional maybe halving cycles that everyone just expect here and they are coming out. So you have that, you have institutions on the rise and they're going to trade Bitcoin as risk on tech assets, and that education and kind of timing takes effect on a lot of people in the market participants here. And then I think also that you have a whole other, conversation stuff that we write about and talk about is like this liquidity that's been with risk assets for the last 5 to 10 years, that's been injecting liquidity in the market. Everything's performed that way. Bitcoin's correlations at times have been so incredibly high across whatever, kind of high beta growth asset you want to look at. And so now you get to a point where all of that's cooling down with rates rising, growth, kind of deflation on the horizon, kind of growth outlooks getting less and less. And it's just not been, 2022 is shaping up like in the turn of year to just not be a favorable time for risk on assets or Bitcoin. You need some like exceptional Bitcoin catalyst to come in and really turn that narrative around, and just market dynamics of how these things are correlated with other risk on assets and yields. So I think now it's obviously the levels that we've been looking at to say, okay, I think maybe about 3 weeks ago, we talked about something like the short-term holder cost basis of like 46,000 level and saying like, okay, if Bitcoin could reclaim above this for some time and show some strength, that would be a good sign that like maybe there's a bit of a specific Bitcoin market kind of divergence happening here and didn't quite get that. And now, our base case is that there's more downside that's coming and it's not necessarily Bitcoin specific, it's just more macro market specific. And I don't think Bitcoin can kind of get away from that, but it's more of the bullish case we have kind of post that downside for the asset itself.
I'm not going to ask you the question that you told me not to ask you, but I want to talk to you a little bit about what we're seeing coming out of the Fed. It seems as though the markets are dictating to the Fed to be very aggressive with their rate hikes. I asked you a few weeks ago, like, what would it genuinely look like if we just ignored what the Fed did and let the market dictate these rates? The Fed's just going to respond accordingly, I believe. I'd love your thoughts on sort of where your expectations are for Fed rate hikes and what effect that could have equities and Bitcoin market and bonds as well.
Yeah, totally. So I would say, yeah, even if the Fed is behind the curve and they're not raising rates and the market is doing it for him, you're seeing a sell-off in credit on all sorts of durations in terms of like treasury and kind of high yield credit. And, that could be a good function of that inflation is where it's at and you see these negative real yields. But you're not really seeing that like safe haven treasury kind of asset play that's been in yield so far. Now we're like up to 3%, I think close to it on the 10-year, like right below that. So we'll see if that holds or there's more sell-off to come. But even without thinking like, okay, if the Fed is just signaling market rates or they're just like signaling broader monetary and fiscal policies that can happen in the future, still markets are kind of they're raising rates a little bit, but they're also baking in expectations for these rate hikes anyway, whether they have a huge material impact or not on the market. So, currently right now, the May 4th meeting is coming up, and I think mostly what markets are pricing in is 50, basis point rate hikes through the rest of the year for almost every meeting, maybe a little bit shy of that. And that gets, the Fed to this, have an idea like the terminal rate in mind and like the rate that's, meant to be met for, proper growth and inflation, whatever that means. But ultimately, I think what you're going to see is that, the inflation problem is just too much of a concern politically. So even if you're saying like, okay, the Fed doesn't have, much impact on these market rates, the market's doing for them, I think they have to show whatever monetary policy steps that they can to show that they're kind of fighting into that. And that's really the bigger concern because, inflation at 40-year highs, you have 40% of Americans that essentially have less than $1,000 in savings, where that's really hitting the most. So I think, in this reality, they don't have too many options, but to try and take that away and try and take that liquidity away, although maybe they should have done a long time before. And then eventually you get to a point where, the kind of our base case is that, or mine is, that as this unfolds, you're taking that liquidity out of the market, a market that's grown largely based on that liquidity and other factors and speculation. And then you're just completely removing that, trying to roll down the balance sheet, trying to take out, trying to have more quantitative tightening. And that's more downside for risk assets to come. And I think, obviously May 4th will be a good signal. Like if 13% in the SPX and 20% in the NASDAQ, I don't think that's enough to say that the Fed is just going to like start reversing course now. Would expect that to play out much later this year after they're tightening, almost because they have to at this point because it's catching up to the market.
Look, we've heard Powell essentially allude to this 50-point basis hike, possibly two back-to-back. I believe it was Canada that actually just did a full 1% rate hike on their own markets. Do you see or envision like things getting so out of hand that the Fed has to be even more aggressive than a 50 basis point hike? And what could be the events that cause more aggression?
Yeah, I would say, well, I mean, there's some members of the Fed, I guess, who are pushing that, whether they're just talking about it and trying to raise market expectations in that way. Like Bullard has talked about getting to like a 3.25% kind of target rate. Again, that's 50 basis points and even maybe a 75 basis point rate hike through the rest of the year. I mean, the thing that would make them tighten further or have to really is just more acceleration, rate of change in inflation, how I see it. And not to say that inflation is not here to stay in the US. It certainly is going to stay at high elevated levels. But I think we get closer to essentially that peaking, the kind of base effects of what like inflation is built off of can only stay so incredibly low relative to the pandemic for so long. And the rate of change when you're talking about, okay, you have inflation at 8.5%, how much higher that can go into 9 or 10. So I think we get like maybe a reversal there. I mean, we'll see how the latest kind of supply chain data is taking forward within the last 2 months. But I expect that to still remain like pretty elevated, like CPI level, like 5 to 6% for the rest of the year, although that's largely below what most people would expect CPI or inflation overall to be an estimate. So I think for them to really just go like Paul Volcker style rates is like you'd have to have this like persistent 8.5, 9, 10% style inflation where they just say, okay, like 50 basis points is just like totally off the table. We have to go much higher than that. But then again, you get to the point where, at the end of the day, like the conversation is how much higher can rates go to pay, the deficit and the interest rate expenses that we have. And so eventually like those have to have some type of ceiling or cap to, kind of be able to afford instead of kind of going through these austerity measures or kind of going bankrupt on the debt itself, which I think are politically, not viable options.
Sam, did you get a chance to watch the IMF panel that happened last week? I believe it was late last week.
No, I think I saw some clips of it surfacing. No, but I didn't see like.
You can take a look. It was interesting. Yesterday on FedWatch, we talked about it in detail over here on the show. So folks can catch that on FedWatch or on Bitcoin Magazine YouTube. But it was pretty much a panel of central bankers, and they were just talking about a lot of these questions that we're kind of asking you. But when Powell was asked that question, he actually let loose that within the inner circles at the Fed that a lot of the decision makers or the influencers feel that quarterly 50 basis point hikes are appropriate and on the table. So that was some interesting information. So I know that obviously 50 basis point is not massive, but obviously FedWatch, we've been saying that the Fed only can manage impressions and manage expectations, and that's really what they're just focusing on here. I guess, do you have anything to kind of add to that kind of information?
No, I mean, I think I would say like, kind of what you're hearing in terms of that panel or like what Powell is saying is that like, that's essentially what markets are pricing in today as well. And essentially that it shifted in the sense that, the sentiment is to focus on inflation and signaling that you're trying to do that, whether you're having an impact on those rates. And so when you look at like the CME, they have a great like rate hike probability tool where you're looking at kind of based on what market positioning is and certain data in the market. Here's what is essentially implied for what the market is expecting. And so I think over the next few meetings, that rate hike probability is expecting 80 to 85% chance of those 50 bips rate hikes. So I mean, that leads me to believe that there really is, this is the path that we're going down. Essentially just going to continue doing it until that ends up being some bigger liquidity crisis in the markets, if that's to play out, or leads to some kind of recession, deflationary impact that has to come after kind of this inflation force today. So as much as like Fed talks and says that, what you just said and like what I'm looking at and seeing in terms of like just the market data that's on the table today, that does change a lot though. Definitely confidence that over the next like 2 or 3 quarters that they're going to consistently try to rate hike basically until something doesn't work or markets get to the point where you might say it's like the the Fed put, where the S&P is down, another total like 30%, and that really is the time when things are breaking worse, and so that's when they have to reversal. But I would definitely agree that or be convinced that that's happening, even though I haven't been as convinced on kind of Fed speak in the past.
I'm going to space on what exactly you and Dylan have been posting about, but the metric regarding coins on exchanges, I believe, or coins that have not moved, is reaching new all-time highs. Can you touch a little bit about just sort of correct whatever I just said that was wrong, B, sort of explain to everyone why that metric matters and why you guys are paying such close attention to it?
Yeah, so maybe you can help me clarify what you're thinking. So you have balances on exchanges, you have coins on there, or you have like coins that have not moved over like a certain time period. So like that one. Okay, cool. Yeah. So basically, I think what Q's referring to is like coins that haven't moved in addresses and wallets over a certain amount of time. And so, one that we track a lot, and just in terms of like general holding behavior, is like coins that haven't moved basically over the last year, that have been sitting there, which are good kind of holding indication that one, more kind of holders on the network are like growing their share of coins there. And new people that are coming to the network are holding coins for like a longer time period. So if you look at that metric right now, that's like around 64%. So it's hitting like these new kind of all-time highs. A big piece of that metric too, though, which is, if you're looking at the holder activity, the more active people, you like to see that number kind of increase, because it's kind of showcasing like through these more bearish markets and things that are happening, more people are holding coins for longer, and there's not enough selling, and you're going to have this period of like hodling behavior that's got to stick around at pretty high clips through this kind of monetization phase that we're going through. But what's also rolled into there is that coins that basically haven't moved in like 7 years as well. And so we consider like a lot of those coins either lost. Those would include Satoshi's coins, but coins that have not moved in like 7 years, you're expecting most of those to not come back to the network. They certainly can. There's been cases where that happens, but for the majority of them, you're expecting them to kind of be gone, and maybe just a donation to the supply that's there today. So, what's been happening with those is like a lot of those coins just aged into like older than 7 years. So that number has been getting pushed up pretty high, which is a good indication of holder activity. But like right now too, it's more so driven by a lot of lost coins in the network that are kind of aging past there, which it also is like a pretty strong case for just, another kind of variable on Bitcoin's kind of limited supply. Like when you think of like, okay, 21 million supply, there's estimates for lost coins that put supply more like 15, 16 million. And then you have this other dynamic that's happening like every 5-7 years, you have an assumption that coins that are not coming on the network are basically lowering that supply as well. So not saying in the future we can see some of those come back, but it's a pretty indicative of like the supply side things that we talk about, of just being one of those metrics that say, hey, even during this period down 44%, whatever it is, we're from price all-time high, that a lot of the hodling behavior of people that have been around for a cycle or even over the last year or 2 years is really not changing all that much. So that's promising from a supply side, which leaves like less Bitcoin on the market to get influence from like more of these macro trading, kind of credit unwinding, position unwinding type moves.
I'm going to start calling you Randy Moss.
What is that?
Because he caught the worst throw that this dumbass ever threw in his life.
All right. Well, yeah, that's fair. That's pretty bad. I want to hit on something that you wrote about last week, which is interesting because this is the first time that we've started to see this happen in a while. But GBTC, the discount is starting to shrink. So effectively, this is the story. Am I? Hello. Can you guys hear me? Okay, maybe Q can ask. I don't know what's wrong.
DK, just start talking.
Yeah, no, I was just gonna say, I wanted to ask about the GBTC premium and it's shrinking.
Yeah, totally. So we wrote a piece on this essentially through last week, and this has been something, essentially GBTC. We got some good pieces on this, just being like a huge driver of the bull market that played out. GBTC taking on a huge amount of Bitcoin. Now their holdings are over 650,000, 640,000, somewhere in the ballpark there. And then you had, just in terms of like the premium discount, when you had that going on, you had basically people being able to arbitrage the price between the shares that were kind of locked up and traded on the market. And so for a while, there was this huge premium that was trading on GBTC. And essentially, as price fell and demand has fallen, and there's other vehicles that have popped up to get Bitcoin, there's been a large discount rising there. So, for holders of GBTC, like over the last 2 years or so, there's been a huge discrepancy in terms of like Bitcoin returns versus GBTC returns, because you have like this big prevailing discount, like in the going market rate price, and essentially what the share should be relative to the price of Bitcoin and what it represents, just kind of by the nature and structure of the vehicle. And that's why there's been such a demand for a spot ETF as well, because this is a huge institutional investor product. This is one where you can get, outside of mining that we talked about before, like the exposure to owning Bitcoin, actually, for a lot of people, a lot of institutions, but those returns are pretty significant. So like with this regime of discount reaching down to like 30%, you have these like Bitcoin returns like over the last 2 years. Checking it now, it's like 470% return on Bitcoin. If you're holding GBTC, it's like 260%. And then if you flip that since 2021, essentially you have a return of 24% on Bitcoin and like negative 18% on GBTC. So, but now what I think of like this discount at 30% has been an interesting like new investment case for investors to want to get Bitcoin exposure, because essentially what you can do is you can scoop up shares of GBTC, which is trading now 23% below, so that's closed a little bit from its 30% peak. And as that gets closer to a spot ETF vehicle being proposed or transitioned here from this trust vehicle from Grayscale to a spot ETF, you're going to see that discount close. So essentially you're getting like this additional upside on Bitcoin if you're buying into this discount and it closes into spot ETF. So obviously Grayscale's had a huge marketing push, potentially like, putting out a lawsuit, depending on, I think there's a decision on July in terms of one of their applications. But what this kind of premium discount kind of also represents, it's interesting in the market, is just, it gives like implied market probability odds of when this thing might start closing or get closer to a spot ETF. So I think that's, one of the parts of the piece we said interesting to watch. I think still we're probably far away from having that spot ETF approval. Some really great Bloomberg ETF analysts that have covered everything Bitcoin ETF and ETFs in general kind of benchmark some of the kind of legal concerns to get hashed out by summer 2023. Could be sooner than that. But I think that's why this is such an interesting kind of premium discount to watch, because ultimately as the odds of this gets closer to being a spot ETF, you should see that premium close as more investors start to come into this trade, and maybe that conversion of a spot ETF risk gets reduced.
Can you guys hear me on Spaces? All right, there we go. That was my bad. Sam, really great information. We hit on a bunch of stuff. We focused mostly on the state of the Bitcoin mining industry, public Bitcoin miners, talked about Bitcoin market outlook. Are we in a bear market? Answer is kind of maybe, probably yes, but unwilling to commit. And then finally talked about GBTC and some of these other outlets. Anything else you kind of want to add as like a final word? And let's make sure to tell people about Bitcoin Magazine Pro.
No, I'll just say, if you like any of this type of information, whether it's hearing it or through more writing and charts and data, check out Bitcoin Magazine Pro, Substack link there. You can sign up for kind of a free subscription, or we also have a 30-day trial promotion there if you're interested in the premium. But yeah, I mean, everything we cover from Bitcoin mining, macro, derivatives, on-chain analytics, try to be full encompassing. So yeah, if you're into that information, check out Bitcoin Magazine Pro or shoot me a follow on Twitter.
BitcoinMagazinePro.com. We got to make sure we practice saying that one, but we got that shiny new domain as well, so that'll take you right to the right place. BitcoinMagazinePro.com. Last word, Sam.
No, I think that's it. Thanks guys for having me again. Appreciate it. So talk to you guys next week.
Cool. Chris, Q, always a good time. I'm still bullish. Mirror multiple is below 1. That means you should be stacking. And I mean, hey, just play it safe and never stop buying Bitcoin. That's what I have to say.
We want to go to commercial? All right, we're going to a commercial break, guys, so I can eat a banana. We'll be back.